There's a point in your early 60s when the finish line stops feeling theoretical and starts feeling close. You wake up one morning, check your portfolio, and realize the number staring back at you isn't a dream anymore. 1.6 million. You've done the work. You've saved consistently. You've built a comfortable life. And now that quiet questioning you've been avoiding starts to echo a little louder. Could I actually retire? Maybe even right now. You start running the math in your head. 10,000 a month should be fine, right? That's 120,000 a year. My investments can cover that, can't they? But the moment you ask it, another voice shows up. What if the markets drop? What about inflation or taxes or living another 30 years? Because what used to be a distant calculation suddenly becomes real. This isn't about chasing returns anymore. It's about protecting lifestyle. It's about making sure that 1.6 million doesn't just look like enough, but feels like enough. Hi, I'm Tom Porteous, Senior Wealth Advisor at CG Wealth Management. If you're in that stage where the spreadsheets are starting to turn into life decisions, wondering if your savings can truly support 10 grand a month without running out, feel free to book a quick call using the link in the description below. Now let's talk about what that number really means and whether it's possible to retire at 62, live the life you want, and still have peace of mind 20 or 30 years from now. At 62, 1.6 million sounds like a lot, and it is. But once you start translating it into monthly income, that number feels a lot smaller. Let's say you want to draw 10 grand a month, that's 120,000 a year after tax. If you simply divided your 1.6 million by that spending, you'd get just over 13 years of income. But of course, your portfolio earns returns, and inflation is quietly eating away at your purchasing power in the background. So the question isn't, do I have enough to retire? It's, how long can I sustain this lifestyle after taxes, inflation, and volatility? That's why I always say retirement isn't a number, it's a structure. When somebody asks me, can I retire now? I never answer with a simple yes or no. It depends on 4 key variables that work together. Your spending rhythm. Is 10K your base lifestyle, or does it include travel, gifts, and extras that fluctuate? Your tax exposure. How much of your income will actually reach your pocket? Your market risk. Are your assets built for stability or volatility? Your longevity. How long might your plan need to last? Each of those factors pulls on the others. Spend more and you'll need higher returns. Take on more risk and you'll need more stability. Live longer and your plan needs more endurance. So it's not just about if 1.6 million is enough, it's about how efficiently you convert it into income that lasts. The real numbers behind 10,000 a month, let's break it down. Imagine your 1.6 million looks like this: 900,000 in RRSPs, 300 in TFSAs, 400 grand in a non-registered portfolio. You want to spend 10K a month after tax, or 120,000 a year. If your portfolio earns a conservative 4.5% annual return, that gives you roughly 72 grand in gross income. Not enough to hit your goal without drawing capital. So to reach the 120,000 after tax target, you'll likely need to withdraw 160,000 a year pre-tax, assuming a 25 to 30% effective tax rate. That's a withdrawal rate near 10%. Which is too high to sustain for 25 plus years. That's where planning makes the difference between I can retire and I can retire confidently. The tax trap hidden in your accounts. This is where most people get caught off guard. You might have 1.6 million saved, but not all dollars are created equal. Withdrawals from RRSPs are fully taxable. Withdrawals from non-registered accounts trigger capital gains and dividends. Withdrawals from TFSAs are completely tax-free. So if you pull income only from your RRSPs early on, you're not just paying more tax now, you're setting yourself up for larger RRIF withdrawals later when you're forced to take income whether you need it or not. That can push you into higher tax brackets and even trigger OAS clawbacks in your 70s. So the key isn't how much you withdraw, it's where you withdraw it from and when. That's why we structure income in layers to balance taxes now and in the future. The market timing risk few retirees see coming. Now, there's a subtle risk that can quietly derail a plan. sequence of returns risk. It's not just how much your investments earn that matters, it's when they earn it. If you retire during a market upswing, your portfolio can easily sustain withdrawals. But if you retire into a downturn, say 15–20% dip early on, your withdrawals amplify those losses, leaving less capital to recover later. That's why I separate portfolios into 3 horizons. Short-term income, 2 to 3 years of predictable cash flow. Medium-term stability, the next 5 to 10 years of conservative growth. Long-term growth, investments designed to outpace inflation and replenish income down the road. When you have your short-term income protected, market volatility stops feeling personal. You stop worrying about the next quarter and start thinking in decades again. Inflation, the silent erosion. At 3% inflation, your $10,000 monthly lifestyle will cost you $13,500 a month in just 10 years. That means your portfolio must keep growing even after you stop working. So while it's tempting to move everything into GICs or low-risk income funds for safety, that safety can come at the cost of purchasing power. You still need growth assets working quietly in the background to offset inflation. Because the goal of retirement investing isn't just to preserve wealth, it's to preserve lifestyle. Here's another reality check. If you're 62 today, there's a 50% chance that one partner will live into their 90s. That means you need to fund 30 years of income through changing markets, taxes, and healthcare costs. So the question isn't, can I retire now? It's, can my plan last if life goes longer than expected? That's why I encourage clients to plan for longevity first, comfort second. Because if your plan works to age 95, it will work for every version of the future in between. How government benefits fit. Now here's a hidden advantage you might not be factoring in. CPP and OAS. For a couple receiving full CPP and OAS, that's roughly $45,000 to $50,000 per year combined. That covers nearly half of your $10,000 per month goal before you even touch your portfolio. If you delay those benefits until 70, your lifetime income could increase by over 40%, a powerful inflation-proof safety net later in life. So by coordinating withdrawals early and delaying government income, you can build a much smoother and more resilient income path. Here's an example. Let's take a couple, both 62, with a $1.6 million saved and no debt. They want to retire now and spend $10K a month after tax. We structure their portfolio into 3 buckets. $400,000 in low volatility income holdings to fund the next 3 to 5 years of spending. $600,000 in balanced investments for moderate growth and replenishment. $600,000 in long-term equities to protect against inflation. They draw modestly from RRSPs and non-registered accounts now, deferring CPP and OAS to age 68. By coordinating withdrawals and managing tax brackets, their plan supports that lifestyle to age 95, with even conservative returns and inflation factored in. Same portfolio, same returns, completely different outcomes. That's what happens when you retire with structure, not just savings. At some point, the math gives way to meaning, and people finally see the plan on paper. They stop asking, can I afford to retire? Because once you have clarity, real clarity, the anxiety fades. You stop checking the market every morning. You stop second-guessing your spending. You start focusing on what the money was always meant to buy: time, freedom, and peace of mind. If you'd like to stress test your own plan to see whether your $1.6 million can truly fund $10,000 a month sustainably and confidently, feel free to book a quick call using the link in the description below. We'll walk through your structure, your tax plan, and your income strategy so you can move forward with confidence, not hesitation. Because at some point, retirement stops being about growth and starts being about balance, control, and peace of mind. And when you finally reach that point, 1.6 million isn't just a number anymore. It's the foundation for the life you've always been working towards all along.